Imagine waking up one day to find the world's financial system turned upside down. Not by a war or a pandemic, but by a sudden, violent stock market collapse that almost no one saw coming and even fewer remember today. We all know about the Great Depression of 1929, Black Monday in 1987, and the 2008 global financial crisis. These events are etched into our collective memory. But what if I told you there was another crash, one that sent shockwaves through the global economy, destroyed fortunes overnight, and changed finance forever, yet has been almost completely erased from public consciousness? This is the story of the forgotten crash. A market meltdown so severe that for a moment it threatened to unravel the very fabric of capitalism. Decades later, it's barely a footnote in history books. Why? Because history is written by the survivors. And the survivors of this crash had every reason to move on, to rebuild, and to forget. But if we ignore the lessons of this lost disaster, we risk repeating its mistakes that could be even more costly in today's hyper-connected world. To understand how a crash can be forgotten, we need to travel back to 1973. The Vietnam War is winding down. The United States has just abandoned the gold standard, unleashing a new era of volatile currencies. Oil prices are about to quadruple thanks to an OPEC embargo. Inflation is rising, unemployment is climbing, and the sense of post-war optimism is fading fast. Against this backdrop, the stock market begins to wobble. The Dow Jones Industrial Average, which had peaked near 1,000 points in early 1973, starts to slide. At first, it's just a correction. But as the months go by, the losses mount. By the end of 1974, the Dow has lost almost half its value, plunging to just over 570 points. In percentage terms, it's one of the worst bear markets in history, worse than the 1987 crash, worse than the dot-com bust, and rivaled only by the Great Depression. So why don't we talk about it? Why isn't the 1973-74 crash a household name? The answer lies in how we remember history. The 1970s were a decade of crisis oil shocks, political scandals, runaway inflation. The stock market's collapse was just one disaster among many, overshadowed by Watergate and the fall of Saigon. There were no iconic images of traders weeping on the floor of the New York Stock Exchange. No dramatic headlines screaming Black Monday. The pain was real, but it was diffuse, spread out over months and years. But make no mistake, the impact was devastating. Millions of Americans saw their savings wiped out. Pension funds teetered on the brink of insolvency. Companies that had seemed invincible were suddenly fighting for survival. The crash exposed deep flaws in the financial system, flaws that had been papered over during the boom years. It was a wake-up call, a reminder that markets are not infallible, and the line between prosperity and panic is thinner than we like to admit. Let's consider the psychology of a forgotten crash. When disaster strikes, our first instinct is to find someone to blame. In 1929, it was reckless speculators. In 2008, it was greedy bankers. But in 1973-74, the causes were more complex. Was it the oil embargo? The end of the gold standard? The political chaos in Washington? The truth is, it was all of these things and more, a perfect storm of economic, political, and psychological forces. Contrast this with other crashes. The Great Depression had a clear villain, the speculative bubble. The 2008 crisis had its poster children, subprime mortgages and Lehman Brothers. These stories are easy to tell and remember. But the 1973-74 crash defies simple explanation. It was a slow-motion disaster, a rolling crisis that unfolded over months, leaving no single moment to markets passing. And yet, the consequences were profound. The crash shattered the illusion of permanent prosperity. It forced policymakers to confront the limits of their power and investors to rethink their assumptions about risk. It set the stage for a new era of financial innovation and, some would argue, for the excesses that would lead to future crises. So why does this matter today? Because the forgotten crash holds lessons that are more relevant than ever. In a world where markets move at the speed of light and the next crisis could be triggered by a tweet, it's easy to believe we've outgrown the mistakes of the past. But history has a way of repeating itself, especially when we're not paying attention. We're going to dig deeper into the hidden forces that drove the market to the brink, the human stories behind the headlines, and how this forgotten disaster still shapes our world. To truly grasp the magnitude of the 1973-74 crash, step into the shoes of those who lived through it. Picture a middle-class family watching their retirement savings shrink month after month. Imagine a young professional whose job prospects have vanished. Or a seasoned investor questioning everything they thought they knew about markets. The pain wasn't just financial, it was psychological, a slow erosion of confidence that left lasting scars. This crash was the product of a world in transition. The end of the Bretton Woods system in 1971 unleashed currency volatility. The 1973 oil embargo sent energy prices soaring, triggering stagflation, that toxic mix of rising prices and falling wages. For the first time in decades, Americans saw their standard of living decline, undermining faith in both government and markets. As the crisis deepened, policymakers scrambled. The Federal Reserve was caught between fighting inflation and unemployment. Raise interest rates and risk a deeper recession. Keep them low and watch inflation spiral. The result was a series of policy reversals that only added to the uncertainty. Investors, sensing no one had a plan, began to panic. The selling accelerated and the market entered a downward spiral. While headlines focused on Washington and Wall Street, the real story played out across the country. Companies laid off workers and postponed investments. Home values stagnated, and consumer confidence hit record lows. The American dream seemed to be slipping away. Yet amid the gloom, some saw opportunity. Legendary investors like Warren Buffett quietly bought shares of solid companies at bargain prices, betting that the panic would eventually subside. Their patience was rewarded, but for most Americans, the recovery was slow and uneven. It took years for the market to regain its previous highs, and even longer for the scars to heal. What makes this crash so relevant today is how it exposed the hidden vulnerabilities of the financial system. There was a belief that the lessons of the Great Depression had been learned, that another catastrophic collapse was impossible. The events of 1973 to 74 shattered that illusion. It became clear that markets are governed not just by rationality but by fear, greed, and unpredictable human psychology. This is perhaps the most important lesson of the forgotten crash. Financial crises are rarely the result of a single mistake. They are the product of systems under stress, of institutions and individuals grappling with forces beyond their control. And when those systems break down, consequences are far-reaching and long-lasting. As the market slowly recovered in the late 1970s, the world that emerged was different. The era of stable, predictable growth was over. In its place was a new world of volatility, innovation, and risk. The financial industry responded with new products like derivatives and index funds. Some helped manage risk. Others created new dangers that would only become apparent in future crises. Perhaps the most enduring legacy of the crash is how it changed our relationship with risk itself. For a generation of investors, it was a sobering reminder that markets can go down as well as up. It forced a re-evaluation of what it means to be prudent, to diversify, and to prepare for the unexpected. And it planted the seeds of a new skepticism, a recognition that the experts do and always have the answers. So why does this story matter now? Because the forces that drove the forgotten crash are still with us. Economic shocks, political upheaval, and technological change continue to shape our world in unpredictable ways. The lessons of 1973 to 74, that confidence is fragile, that systems can fail, and that history is often forgotten, are as relevant today as they were half a century ago. It's tempting to believe we've learned from the past, that new tools will protect us from old mistakes. But every era has its blind spots, its own forgotten crashes. The challenge is not just to remember the disasters that make headlines, but to seek out the stories that have been overlooked. The forgotten crash of 1973-74 is more than a historical curiosity. It's a warning, a reminder that markets are built on trust and prosperity is never guaranteed. By studying the past, by remembering the crashes history has tried to erase, we can better prepare for the uncertainties of the future. If this story gave you a new perspective, don't let it fade away. Share it, discuss it, and keep asking questions. Because the most dangerous crash is the one we never see coming. Thanks for watching, and don't forget to subscribe for more stories you won't find in the history books.